Hey, it's AK, and today we are going to talk about position sizing. You guys gotta bear with me a little bit because my throat is jacked up. Spring keeps pump faking and screwing with me, won't show up and stay, and you guys know how I'm a YouTube star. I am very delicate, both physically and emotionally. So I got lots of lozenges. And to show you what I'm talking about, we're gonna use the Macro Ops Handbook, which is a book that our crazy ass team wrote when we first started Macro Ops. It's like 90 pages of solid information, took forever. I don't know why we did it, but hey, it's coming in handy now. So here's the thing, when a lot of people think about position sizing, they think, okay, I wanna put 10% of my portfolio into this stock. So if you have $100, you put $10 into a stock. So that way of position sizing is what we call notional position sizing. But the way a lot of professionals do it is different. When we talk about position sizing, we're approaching it from a risk perspective. So it's not how much money I'm putting into the stock, but it's how much I'm risking by being in it. And I'll explain what I mean. So let's start with a statement. I want to risk 1% of my capital going long Apple stock, and my account size is $100,000. So traditional people that are using the notional idea of position sizing, they would buy $1,000 worth of Apple stock, because that's 1% of 100,000, right? But it's different when you're approaching it from a risk basis. So from a risk perspective, if we were to risk 1% of our portfolio in Apple, that means that we would lose 1% if the trade hit its pre-planned risk point. So a risk point is just like, say you're in Apple and you got in right here. Well, you always want to plan when you get into a stock about when you're going to get out, right? Like if it's not going in your direction. So maybe you would put a risk point right here at 200. So get in at 211 and put your risk point at 200. So if the stock comes down to 200 and hits that, you know to exit, and the 200 level is your risk point. So here's an easier example. So say we were getting into Apple at $98, and then we put our risk point at $97. So then your question becomes, how many shares of Apple should I buy so that if my entry is at $98 and I exited at $97, I would lose $1,000, because that's what we want to risk, right? 1% of 100,000. So the right answer is 1,000 shares, because losing $1 on each of those shares, 1,000 of them, will create a $1,000 loss, or 1% of your assets. Now here's where things get really different between the risk and notional sizing model. Well, if you're buying 1,000 shares of Apple at $98, that's a notional value of $98,000. So if you're thinking about it in a traditional way, you would be allocating 98% of your $100,000 portfolio to Apple. And that seems crazy from a standard perspective, but that's not how professionals think about risk. The actual notional value, how much you're putting into the stock, that's of secondary importance to the planned risk on the trade. So in this trade, our planned risk was $1,000, and we need to size our position based off that. So to properly size a position with this method, you got to know your account size, your planned entry area, and your planned exit area. And then you want to know how much you're going to bet. Are you going to bet a whole 1% of your account? Or are you going to bet 0.75%, 0.5%? So think about the difference between the two ways of sizing. If you say you're allocating 1% of your portfolio in the standard notional amount, you're just investing $1,000. And your risk on that? Well, I don't know. It depends on what you decided. But when you're using the risk method of position sizing, you're investing $98,000. And your risk is very defined. It's $1,000. And this isn't to say that your risk point is going to be perfect, right? Normally when you're trying to determine a risk point, you're trying to put it at a technical area of support, so that if price falls, it stops at that area. This is where the technical analysis comes in. But technical analysis is not 100%. You can have a situation where Apple drops 20% and it could land all the way down here, and you just blew through your risk point that we were talking about before at 200. And that happens. Your risk points are going to be perfect. So you need to keep that in mind when you're sizing as well. So when I was a discretionary trader before I moved to a system, I would never bet more than 0.5% on a trade, because the actual size, the notional size, how much money I was putting in is a lot, but the risk was only 0.5. And the smaller amounts you risk, the more times you can screw up and be okay. So when you're learning, you might just put 0.25% in every trade you're making. The smaller you size, the less profit you're going to get on the position, but the longer you are going to survive. It's safer. And when you're starting out and you don't know what you're doing, you're better off sizing much smaller. And I would say if you're a discretionary trader using technical analysis, then the risk method of position sizing that we just described, that's probably the best way to go. And it all goes into your trade plan, which I talk about all the time. And I'm talking about 0.5%, 0.75%. Well, that's not too much fun to say. What's more fun to say is basis points. This is where the term gets used. And even more fun than basis points is bips. And you've heard people talk about that, right? I'm risking 50 bips on this trade. I'm risking 10 bips on this trade. So a basis point, or a bip, is equal to 1/100th of 1%, or 0.01%. So 1% equals 100 bips. 0.5% is 50 bips. So it's easier to think about these things in bips than percentages, because you're usually going to stay within the 10 to 100 100 bip area when you're betting and making trades. And another thing about position sizing, depending on your strategy, like at macro ops, we size differently based off conviction. If we think this is going to be a really solid trade, we might size at 200 bips, so 2% of our entire portfolio. If we're not as sure, then we might do 50 bips. Now, position sizing is probably the most complicated thing that every fund manager struggles with. They don't have an answer for it because some guys switch up their position sizing, some guys don't. So when I was discretionary, I would just keep a standard 50 bip position size. I would never size up or down. Like, I couldn't figure out what was a better trade than another trade. Alex in macro ops, he's able to do that. He's able to go from 10 to 200 bips. So when he feels really strongly about a trade, he'll size up, which is what you read about in Market Wizards, right? When you have all the things lining up, you really got to swing hard at the easy pitch. And going the other way, sometimes you're not sizing up, but you're sizing lower. So there are traders that when they're suffering a drawdown, they might lower their position size. So instead of doing 50 bips a trade, they do 10 bips. So they're still in the market, but they're losing less and they still keep their feel. So then when things start turning around again and their equity curve is getting a little better, they might increase their position size again. So there's a lot of ways to do it, and it's not exactly easy. Like I said, if you ask a fund manager, that's the one thing they're like, I don't know what to tell you. My advice though, which is not financial advice because I'm not your financial advisor. So you know what? I don't have any advice for you. I'll just tell you what I did, which is to keep it simple. I just kept everything at 50 bips. And this concept of bips and position sizing from a risk perspective, it also plays into that other term you might hear a lot, risk to reward ratio. So you might be risking 50 bips for 400 bips in profit, which is amazing, like 8-to-1 risk to reward ratio, right? Because if you lose 50 bips, and if you win, you make 400 bips, so 8-to-1. And again, this is very different than saying I am going to invest 1% of my portfolio into this stock. And I mean, that way of notionally sizing your positions, that's not necessarily bad. So I told you I switched to systems trading, and when I did that, I moved to the notional sizing. So now with the system I use called the Nasdaq All-Stars, which just rotates through momentum names, I only have 5 positions, and I put 20% of my portfolio into each one of those positions. So it's super simple. I mean, it's much simpler than the risk position sizing that we talked about in this video. But that strategy is a different type of strategy that can use that type of sizing. So it's not a bad thing. And if you want to learn more about that strategy I'm talking about, just click this link up here. I made a video about it that explains it more. I'll put a link down in the comments and description too. It is important to know this risk position sizing too though, because like I said, a lot of discretionary people are better off doing this type of position sizing than notionally sizing things. So hopefully this helped clear up some stuff. If you have any questions, just put them down below in the comments. And if you want more videos like this, make sure you subscribe to this channel and smash that bell so you get an email notification when our future videos come out. We're publishing at least 6 days a week, possibly 7. You'll just have to subscribe to find out. But subscribe and I'll see you in the next video. Stay fallible out there. Bye.